This webinar focuses on positive manufacturing trends in China and India despite sluggish global economic growth and European debt crisis. Number 1. China's manufacturing index rose more than forecasted recently, a positive sign indicating that growth is stabilizing in the world's second biggest economy. India also experienced fastest manufacturing in December. This is an encouraging trend given that output has plummeted in Europe and major economies have cut growth forecasts for 2012. Number 2. On the global trade front, there is a degree of contraction of exports in China, driven by a relative slump in the Eurozone and slow pace of recovery in the US. The key point is that the fast pace of manufacturing in China must not be viewed in isolation. Any deterioration of the European debt issue will impact Chinese exports negatively, perhaps putting brakes on the Chinese growth. Number 3. More important, if the current increase in manufacturing continues in India and China, it will lead to a surge of inflation. This trend is already visible in India. This situation would imply tightening of belts by the two central banks of China and India, leading to a potential slowdown of growth in these two giant economies of Asia. Number 4. In short, the critical question is whether growth momentum can be sustained in China and India in the medium term. The key determinants of this question are speed of European and the US recovery, turnaround in exports, and intensity of inflationary pressures in China and India. Currently, the odds of a sustainable growth momentum are dim unless there is a substantial reversal of European debt crisis at a minimum. This conclusion is built on the notion that the global economies are highly sensitive, integrated, and interdependent, thus discrediting the very idea of decoupling of the Asian region from the rest of the world.